We're going to talk more about the August convention later on this afternoon when I give you some preview. So until then, let's keep those earlier sessions rolling right along. We've got to hear from our friends at CattleFax. CattleFax has got this fantastic dude. He's named Randy Block. He and I have worked together a couple of times doing presentations. Randy's a good guy. He's got a bunch of other folks lined up as special guests. They're going to give you outlook and insights about the beef industry. So let's go ahead and roll that video and let's get right to it.
Good morning. I'm Rod Newlick, and it's my privilege on behalf of Purina Animal Nutrition and our parent company, farmer-owned and operated Land O'Lakes, to welcome you to the CattleFax 2021 Outlook Session at the Winter Reboot. While circumstances prevent us from being together here in person, it does allow me to address you here from our 1,263-acre Purina Animal Nutrition Center outside St. Louis, Missouri. Here, we have conducted continuous research on animal nutrition, health, and management for nearly 100 years. On my commute here to the farm recently, listening to a local morning show, the caller started their question by saying, "The future is really uncertain right now." And I couldn't help but think, hey, if you didn't know it before, one thing that 2020 has taught us is that the future is seldom, if ever, certain. So, in preparation for any uncertainty, I congratulate you on being in the right place this morning as you hear from experts from CattleFax and participate with other cattle industry thought leaders here at the Winter Reboot. And I would suggest to you that I'm in the right place as well. Land O'Lakes continues an unprecedented investment in animal agriculture here at this one-of-a-kind research facility and working farm. Just think about this. Every year here at the Research Center, we collect some 3.6 billion data points. So obviously it's much more than a feed 'em and weigh 'em protocol. For example, beyond feed efficiency and average daily gain, today we can learn whether a treatment has affected the gene expression of immune cells, or we can precisely identify and quantify the microbiome in various parts of the animal's GI tract through DNA sequencing. I like to say that we're finding answers to questions we don't even know to ask yet. But what we do know is those answers will help us to anticipate and solve the challenges our industry will face in the future. So, I'll finish by asking you to visit our virtual booth and to find out more about an exciting new initiative we have that we call Purina Plus. It leverages our collective knowledge into a first-of-a-kind preconditioning program that combines a complete nutritional foundation, proven health protocols, and progressive management to add value to your calf crop and to deliver high-value, low-risk feeder calves that perform. Again, on behalf of Purina Animal Nutrition, thank you for being here this morning and for what you do every day to provide safe and affordable nutrition to a growing world.
The entire beef production chain stands to create additional value by maintaining calf health. That's why Purina Animal Nutrition, along with several other animal health and nutritional providers, are taking a stand to optimize calf health through their new feeder calf program. Purina Plus is designed to set calves up for a strong future through complete nutrition and sound health protocols. Purina Plus is an innovative feeder calf program designed to deliver high-value, low-risk calves to the marketplace.
Over 10,000 years ago, mankind first domesticated cattle. At this exact same time, cattle domesticated us. Our two species have worked together and taken care of each other for centuries. Zoetis is today's advanced answer to that ancient bond. We help make it stronger, healthier, more robust. We are born of the bond.
Hello, I'm Jared Shriver, Senior VP of the Zoetis U.S. cattle business. On behalf of Zoetis, I'm honored to welcome you to the Ncba Winter Reboot and CattleFax Outlook Session. We're proud to sponsor this event to demonstrate our bond to you, the leaders of the beef industry, by bringing you tools and information to help your operation be sustainable for future generations. Now more than ever, we need to have the ability to plan, forecast, and make sound decisions to maintain production and profitability. And as you know, CattleFax plays a huge role in helping us do that. So thank you for your continued efforts. During this session, Dr. Art Douglas will be discussing the evolving weather patterns with an emphasis on grain and energy markets, as well as on international trade and how the changing economy could impact cattle markets in the year ahead. At Zoetis, we know the bond between cattle and humans runs deep. It's a two-way relationship to care and provide for the animals so that they can care and provide for us. I invite you to visit the Zoetis virtual booth to learn more about our products, services, and technologies that we offer so beef producers can predict, prevent, detect, and treat disease for advanced animal care and health. We hope you enjoy this presentation and the rest of the NCBA's Winter Reboot. We look forward to seeing you all very soon and want to thank you for all that you do. Take care and have a great rest of the day.
Hold slide. 2, 1. Well, good morning. I'm Randy Block. Welcome to the NCBA Winter Reboot. It's our pleasure as CattleFax to have the opportunity to share with you today the 2021 market outlook and outlook for the next several years. Today, the CattleFax staff, Mike Murphy, who most of you know, Mike is the Director of Research and our Vice President of Risk Management Services. He's been with CattleFax for 25 years. He'll be joining the stage with me in a little bit. Also, Kevin Good, our Vice President of Analytics and Member Services. Kevin will be joining us. Kevin's a 39-year veteran with CattleFax, and both these folks will be on stage here in a little bit. So today I'm going to start out our Outlook session with just giving everybody a review of where we are. And again, we've come through an incredible time here over the course of the last few years. Starting back in here, if we think about the situation that we had with the Tyson fire back in August of 2019 and then COVID in 2020. You look at these situations with what we're doing in here and how things are transpiring. We've obviously had several events that have had a major influence on our business. So when you think about these black swans that we've had to navigate through, we're still dealing with some of the aftermath of those events. And the staff and I today will go through and give you a feel of where those things sit. Obviously, we backed up a lot of cattle last spring when we come through this situation. We backed up nearly 1 million head of fed cattle in our production systems. We've pretty well got the slaughter back on pace in here, but we're still putting record tonnage through these systems. So with the record tonnage that we've got moving through these markets today, again, that's testing. These markets are still underperforming relative to the potential that's out in front. So we'll spend some time with you today going through that and showing you where we expect to see these markets make a transition. Again, the markets have had a nice recovery from where they were back in here at the summer lows of 2020 when we were selling cattle at $95. We're now in here at $114. So the markets have had a nice recovery, but there's still significant potential above where we're sitting today. Obviously, the drought has continued to spread, as Dr. Douglas said it would a year ago, that we'd continue to struggle with the La Nina weather event. As I look at where we are in here, again, the herd is continuing to contract. That's not been a surprise to us. So again, we'll go into more detail on that as we go through today's session. The Outlook Seminar today, we're going to talk about the recovery, where we are with the inflation impact. Obviously, we're in kind of a global bull market that's developing in here in commodities, aren't we? So I want to discuss that with you when we talk about the market landscape and what the business environment is going to look like here over the course of the next several years. I think there's some very key developments in here that we need to all discuss and think about. I mentioned the fed slaughter to you a few minutes ago as I started my comments. Look at that V bottom right in the middle of the screen in here. That shows you how much impact COVID had when we couldn't run these plants at our maximum capacity back in here in April and May. That was the time period where we under harvested. The packing plants have done a wonderful job of adapting to this new COVID situation with spacing, doing what they've needed to do to keep their employees safe. Again, I think they've done an incredible job as we've been able to work through here. These Saturday harvest levels since mid-June of last year have actually averaged about 52,000 a week. So some of the largest Saturday harvest levels in history. Again, that's what's allowed us to pick up some of the slack where we haven't been able to run the plants as hard during the typical 5-day, 40-hour week. So we've made progress in here. I think you have to feel good about it, but we're still not where we want to be. I think all you have to do when you think about our markets, I know a lot of you out there are frustrated because you're sitting there saying, why can't this market go? Again, there's a lot of margin above us. We've had record packer margins. We've had record retail margins out here. All you have to do is look at the red line on this graph and look at the red line from June all the way through the end of last year and even into the first quarter of this year. These are record production levels, record beef production levels. Never before in the history of our industry have we put more product on the market than what we're doing on a weekly and monthly basis through here. So this has been what's holding us back to some degree. Obviously, you've seen some weather impact in the last couple of weeks. It's going to shave some tonnage off these markets, but bottom line is we still have plenty of cattle to harvest as we're working through here yet and just continuing to work through the backlog. But there are better times to come, and again, our staff will get into that in more detail today. I think maybe the most important thing for all of you to think about and chew on, anybody associated with the beef industry, and you think about where we've been, all the times we've been through over the last 30 to 40 years. The beef demand growth that we've experienced in here since 1998 has been unprecedented. Look where beef demand was. Look at the gray bar in 2020. We had the strongest beef demand in over 30 years this year in 2020. And in 2021, again, it's going to be another strong year based on everything we're looking at out here. Kevin Good will walk us through the details in that in a few minutes. But the bottom line is when you think about what's happened in here, the beef demand growth has added over $250 a head to the value of these fed cattle over the course of the last several years. So this has been pretty phenomenal. Retail meat sales, even though our food service operations were hammered in here through the spring and fall, we had situations that our sit-down dining restaurants in many cases were running at 50 or 25% normal capacity levels in here. Retail picked up the slack. And again, look what these total meat volume, not beef, but total meat sales volume was up 10% in 2020 at retail. The total dollar increase at retail was up 18% or nearly $13 billion. And look what beef share of that increase in spending was just this last year at retail. Don't confuse this with market share. This is just at retail. The growth we had this last year was nearly $6 billion, $5.7 billion growth in spending for beef. So again, this was an incredible year that we went through. People voted with their pocketbooks. I think we've got to like what we've seen transpire here. Well, what's ahead? What's this economic landscape look like as we look down the road here? Obviously, the unemployment rates have been elevated. That's been well documented over time. But I think the most important thing for you is look at the bottom highlighted bold point here for you. Household wealth increased more than $620 billion in 2020. This is from government transfers. This is government spending, all of the support checks that have gone out here. Households are sitting on a lot of money in here today. As this economy opens back up, again, people are going to want to get out and spend money. And I think restaurants will do very well. We'll see those bounce back. We're going to see the travel industry bounce back. We'll see the hotel business bounce back. The inflation rates have been historically low over time. Again, I'm giving you this view all the way back in here to 1980, so you can see how low inflation has been really over the last decade. Most of the time, we've been sitting here at 1 to 2%. It's not going to stay here. With the current fiscal policy the way it is today, you need to be anticipating that we're going to see a significant increase in the inflation rate over the next 2 to 3 years. That's going to make the cost of doing business higher all the way through our system, isn't it? But the cost of goods sold is also going to increase. So just keep that in mind as we move forward. Interest rates. Interest rates have been historically cheap as we've come through here. And again, the lowest rates on record. Again, interest rates, as inflation picks up, you need to be anticipating 18 to 24 months down the road, we're going to have a higher interest rate environment. You need to be prepared for that. Who knows for sure when that's going to start, but based on what I see happening in here from a fiscal policy standpoint, I would guess it'll start sooner than later. The GDP growth that we anticipate this year, we think we're going to arrive somewhere close to 6% GDP growth. Some of that will depend on how fast we get the population vaccinated here in the U.S. and in other key parts of the world. That will dictate how fast this economy really opens up and where people can get out and spend some of that money that they're sitting on. But again, I think we're looking at 2 years of strong GDP growth as we come through the recovery post-COVID. So the bottom line, this is where I would put the state of the industry. If you look at our industry today, is the consumer balance sheet's in the strongest position it's been since the early 2000s. We've seen unprecedented amounts of savings in here. We're up nearly $2 trillion in here. And when the economy opens back up, the job market's going to improve. People are going to want to spend money. You look out here at where our household net worth is. The government data would suggest that household net worth has increased $5 trillion in here. That bodes well for demand going forward. And again, with the GDP growth that we talked about, I think that looks very solid. Where are we in the state of agriculture? Agriculture, loan repayments are up. Operations have paid down debt with the government funding that we've seen. The percentage of loans that are in have major repayment problems are at the lowest levels they've been since 2014. All of that tells you the economic landscape for agriculture is stronger. Land values are increasing. Again, and we're now in a situation where we're going to see global demand for proteins, grain, fuel, energy, all those things increase. So this should be a nice run for the agriculture industries here over the next 3 to 4 years, I think is the economic landscape that you should expect. We'll go into all these things in more detail as we roll out the outlook here in the next few minutes. Now it's my pleasure to introduce to you Dr. Art Douglas. Dr. Douglas has provided the long-range weather forecast for CattleFax for 45 years. He first gave his first outlook at the convention in 1977. And there's nobody that he's been a pioneer in long-range weather forecasting. He's done a phenomenal job. Again, he's been so accurate here over these last several years. Dr. Douglas, we're looking forward to your comments. Thank you very much.
Randy, thank you for that introduction. It's good to be here, even though the circumstances with COVID doesn't let us be in person. But it's a pleasure to be here. We're going to talk today about world weather and crop conditions, and finally look at the extended range outlook for the United States, February through summer 2021. The outline for the talk today, first we're going to talk about La Nina. It has leveled off, but based on NOAA forecasts, it's going to return come the summer. And as we get into the fall, it looks like we're going to have a moderate to strong La Nina event across the world. Second part of the talk will be a review of world weather and crop conditions. We've seen a strong response to La Nina around the world, and therefore whatever's going on in the world right now is likely to continue for the next 12 months. And then finally, the US weather outlook, late winter through summer 2021. In this next graphic, we're looking at the sea surface temperatures on February the 17th. This is a mature phase La Nina map. The coldest water now is in the central equatorial Pacific south of Hawaii, but we have companion cold water pools from the west coast of North America extending towards that cold water, as well as from the coast of South America extending towards the La Nina event. Anytime we have a cold sea surface temperature in the central Pacific, as well as cold off the west coast of North and South America, this is a drought producing type pattern. In companion with that, we have warm waters off the east coast of North America and South America, and those warm water pools favor drought producing highs in the eastern portion of the continents. Finally, if we look way out there in the western Pacific, that's where the warmest water is, and that's favoring a jet coming out of Southeast Asia towards the North Pacific, but those storms are not getting into California. If we look at the two forecasts going forward, the top map shows the NOAA forecast. It's a set of ensembles, about 22 different ensemble runs. They're pretty similar to each other in that they show a leveling of sea surface temperatures right now in February, March, and April, and then just a gradual downhill trend to water temperatures running almost 1.5 centigrade below normal come the fall. The ECMWF forecast has not done well with this La Nina event. It never forecasted the development of La Nina. And if we look at this forecast, it's also very suspect. It shows much stronger warming going towards June, but after June, the individual members really take off in different directions. Some are much warmer than normal, and others are colder than normal. So I don't think we're going to put much credence in the ECMWF forecast. This is the sea surface temperature forecast from the NOAA model for August through October 2021. And I think you can see on the graphic, the model is indicating a very expansive La Nina situation along the equator, but it's also keeping warm water in the North Pacific and the North Atlantic. This combination favors a polar jet way far north of normal and weaker than normal in terms of its impact on the United States. With La Nina worldwide, there's a strong response in terms of where the maximum precipitation and rainfall is. This is a satellite-derived estimate of cloudiness and rainfall for the world over a 90-day period ending February the 17th. The browns indicate where drought is occurring. So if you look right there, smack dab in the center of the map, we have very dry conditions along the equator near the date line, right where the coldest water is. So the cold water inhibits any type of rising motion. We don't have thunderstorm activity over that ocean. If we look where the real moisture is occurring right now over the last 90 days, it's in Southeast Asia. Southern India through Southeast Asia, Indonesia, down into Australia. And again, that's classic La Nina. Drought, on the other hand, is sprinkled all across the area from North Africa, Middle East into India, also through the western and southern United States, through large portions of South America, and also East Africa. This graphic shows the change in the Vegetation Health Index this year versus last year. Browns indicate where vegetation is less green this year compared to last year. The blues indicate where it's been wetter and the vegetation is more vigorous. If we look at North America first, we see drought in northwest Mexico, southwestern US, sprinkled into the southern plains. In South America, we see a large area of drought in Argentina, as well as portions of Brazil. And then finally, we've seen a lot of dryness in the Middle East towards northern India. Australia, on the other hand, after suffering 5 to 6 years of El Nino, has been able to turn wetter. I'm going to look at the United States first. This is the percent normal precipitation for the last 30, 90, and 180 days. If we go to the 180-day map first, you can see that there's been expansive area of dryness out of California, northern Mexico, all the way into the plains. That was pretty persistent there through 90 days, But recently, with this big cold outbreak that we had into the continent, we had some moisture return. But I think it's a very short phenomena, this moisture return, and we're going to turn drier. If we look at the Vegetation Health Index for North America on February the 18th, first off, the white areas indicate where there's snow on the ground and the satellite can't see greenness in the vegetation. So extensive snow cover. 75% of the continent had some snow here on February the 18th. What we can see is the drought in California, Arizona, through Mexico, all of those yellows indicating we're in about the bottom 36% of years in terms of greenness. If we look at the change from last year, we can also see California's drier, Arizona's in terrible shape, as is much of Mexico. And where there isn't snow on the ground in Texas, we can also see that conditions are less green than they were last year at this time. Let's go to South America. Again, if we start at the 90-day map, you can see that they've had a tremendous problem with moisture in Brazil. And also there's a sprinkling of dryness in Argentina. The monsoon was very late developing. They had terrifically hot temperatures through the mid portion of their summer. The last 30 days, things kind of eased up a little in central portions of Brazil. And then finally, in the last 7 days, there's been a return of moisture through northeastern Brazil. But overall, they had a very late start to planting, a lot of hot, dry weather. And again, if we look at the 90-day map, it kind of tells us how much moisture has been out there for the crop to grow. Looking at the Vegetation Health Index for South America, about the best area is far southern Brazil. We see some dark blues indicating that area is in the upper 84% of greenness years since 1982. But if we look, there's a lot of sprinkling of red in Argentina as well as in south central Brazil, indicating the crop is having problems. If we look at the change in the health index from last year, that really shows us that Argentina is the area that's hurting the most. Now, last year at this time, we still had the end of an El Nino event, which favored moisture in Argentina, but now it's turned dry. Again, we can see compared to last year, southern Brazil is doing pretty well. So I think, kind of to summarize, I think crop-wise, it's going to be at least below normal compared to the last 10 years, and maybe possibly the driest year in 5 to 10 years. Looking at Asia, this again is the precipitation percent normal for the last 180 days. If we look down there at the 180-day map, we see that Australia was coming out of its dry El Nino pattern. We get into the 90-day period, we start seeing moisture returning to southeastern Australia as well as northwest Australia. And then the dryness has gradually winnowed away in the last 30 days. Unfortunately, the Queensland area cattle country has remained dry throughout this entire period. If we look up there in India, they had a good monsoon, which is typical of La Nina, so it's wet in that 180-day map. We start getting in the 90-day map, we see a lot of dryness. In the last 30 days, it's quite dry in India. This shows the Vegetation Health Index for Australia on February the 18th. Southeast Australia, where they had those terrific fires, has turned quite green. In fact, in their areas running in the upper 72 to 84% of greenness years since 1982. The same is also true of northern Australia, Northwest Australia territories. They've turned quite green. I have shown, though, in that red circle, the main cattle country in northern Queensland, and they're still suffering. If we look at the change map from last year, again, things are better in Northwest Australia as well as in Eastern Australia. India is kind of a hard picture to figure out what's going on. If we look at the actual greenness map, which is on the left, most of the winter wheat area is quite dark blue, indicating it's in the upper 84% of greenness of years since 1982. On the other hand, we're still seeing that it's lagging from last year, and the main lag is in the eastern portion of the continent. And when it's dry in the east, it does have some impact on wheat, but again, a lot of this crop is irrigated. So I think India is going to be okay, even though it's lagging from last year. Now we're going to go into the forecast for the United States. What I do is a analog forecast method in which I look at climate indices of upper level height or pressures at 700 millibars, 10,000 feet up in the atmosphere, and then I look at sea surface temperatures in the ocean. Let's look at the upper level heights first. During January, we had a very strong ridge across the entire subtropical Pacific and a very deep trough from Siberia into Alaska. That means the jet is way far north of normal. That subtropical jet, which expands all the way across from Japan towards California, is preventing moisture from getting into the continent. The opposite pattern is visible over there in the North Atlantic, in which we have a strong block across Greenland and a trough towards the south. Exactly the opposite pattern of what the Pacific was doing. Then finally, if we look at the sea surface temperatures, we can see La Nina across the equator, but we also see the warm water pools from Japan all the way towards California, and these warm water pools are surviving under that strong high pressure ridge. So I take these 11 boxes and look at years that had similar patterns. This is kind of a confusing, messy looking table, but it's how I make the forecast, make determinations. The chosen analog years are on the left. They're in orange, so they're 2001, 2020, and then 2000. This shows the set of correlations when I put both the upper level heights and the sea surface temperatures together, and you can see most of the correlations are in about the 0.45 range. If we look at the sea surface temperatures, a lot better correlation, about a 0.62. And then finally on the heights, I got rid of the Atlantic pattern, which was totally out of phase with the Pacific, and a very short-term pattern also. So if we look at the heights chosen, getting rid of the Atlantic heights, again, we still have pretty high correlations, about 0.5. Finally, I do a comparison of the analog years with what the CFS, the NOAA model, long-range model is doing, and I try to compare what the upper level heights in March, the spring, and the summer are compared to the analog forecast versus the NOAA. And the orange on the right indicates those years that have better relationships. The forecast for February was that we'd have a terrifically strong high pressure ridge in the North Atlantic, blocking all storms from entering the West Coast, which is a very severe drought pattern for California, even up into Oregon. We also have the forecast of a pretty deep trough in Canada with a ridge off the East Coast. This is a very tight pattern. All you have to do is move that ridge on the East Coast just a little further east, and it lets that cold air come south, which is exactly what happened. The analog forecast called for a cold northern plains all the way down into the Panhandle, warm in the southeast. It forecasted drought throughout the West Coast, as well as dryness along the Gulf Coast. With that trough coming down out of Canada into the plains, we expected then moisture to develop all the way from northeast Texas into the Appalachians. We kind of do an early analysis of what's happened. Here's the forecast at the top, the two center maps. What has been observed through mid-February are the maps on the far left and the far right. And I think you can see that the cold outbreak was well forecast by the analog forecast, admittedly not strong enough and not far enough south into Texas, but it did do a good job of that. Precipitation-wise, the drought in the West Coast is continuing. It's not quite as dry in the observed map, but all indications are that for the remainder of the month, it's going to be bone dry in that area, and the West will also verify as being dry. Just for comparison, this is the CFS forecast, the bottom two maps. And the CFS never had the intensity of the cold coming out of Canada, In fact, it centered the cold more towards the Ohio Valley, towards the East Coast. So it was kind of off on intensity and also location. Precip-wise, the two maps were very similar, with dryness in the west, Gulf Coast, and then moisture in the Appalachians. This is the spring forecast for upper level heights. The big high pressure that we had there in February is forecast to continue all the way through the spring. Again, this keeps the jet way far north of normal. We still have a residual trough in Canada, allowing some cold to kind of come down along the Canadian border. But overall, looking at the map, it's very difficult for moisture to get into the continent because the primarily flow pattern is out of the northwest, which is a dry pattern. With that big ridge across the Pacific, that keeps the southwestern United States warmer than normal, and it also keeps the western United States relatively dry. The only exception is in California and Texas, where it looks like possibly March is going to be wet, and it's going to be the one wet month for those two areas. A little scary thing is the dryness in the Rockies is also trying to extend into the central Corn Belt. And so that dry pattern we really have to watch going into the spring. The month-by-month breakdown in temperature shows after that cold February, things are going to warm up nicely. In fact, they've already started to warm up. Also, the snow cover that we've had on the ground is dissipating quickly, and I think that's going to be a positive for a warm March. Some cold's going to be able to kind of work down along the Canadian border in April, but by May it's going to turn back warm again. So overall, temperature-wise, not bad for field work, early planting, and quite good for feedlot operations in the plains. Moisture-wise, as I pointed out before, there's an indication that maybe we're going to get some moisture from Southern California into Texas in the month of March. But boy, that's it. If we don't get the moisture, then notice as we get into April and May, the western United States really turns dry, and that dryness keeps on trying to hug the western portion of the Corn Belt. Finally, as we get into the summer forecast, the high pressure ridge, typical of La Nina, persists in the North Pacific. It has a companion ridge downstream over the central United States. There's also a big block up there in northern Canada. The only troughiness that we really have is out of Alaska, kind of touching the Pacific Northwest. Again, it's a very dry pattern. It's difficult for moisture to get into the continent with this upper level height. So going forward with the temperature and precipitation forecast for the summer, very hot summer from the Mexican border north through the Rockies and Western Plains, extending over into the Northwest Corn Belt. Precipitation, likewise underneath that ridge, very dry all the way from the Mexican border to California northward. About the only moisture to speak of for the continent is over there in the Ohio Valley and up along the Canadian border from northeast North Dakota into Minnesota. We do the month-by-month breakdown in temperature. June starts primarily hot in the southwest. The heat moves into the midsection of the country come July, and then by August, much more of the country is covered with hot temperatures. Precip-wise, the plains through the period tend to be the area where dryness is focused, as well as the Rockies. Moisture is very scattered, indicating a hit and miss type summer, which is going to cause a lot of stress with both corn and beans. In this final slide, I'm showing the forecast temperature and precipitation for September. After that really long, hot, dry summer through the Western Corn Belt, things do cool off. The heat goes back to the West Coast. While the cool down is probably welcome relief to the crops, the problem is if we look at the precipitation, it stays dry. If not anything, it's drier. So I think we're going to have some problem with the crop in terms of filling of both corn and beans. And if we look at the western United States in September, it looks like moisture for fall grazing is really going to be inadequate, and so the drought is going to continue throughout the West. Finally, the last thing I'd like to talk about is this news headline that's been popping up in lots of newspapers and on television, is how the warming Arctic, or in other words, global warming there, climate change, caused the big freeze into the midsection of the country. So I inserted a map there showing what the 7-day mean temperature was for the United States through February the 16th. And a good portion of the country from Montana all the way to Oklahoma was about 30 degrees Fahrenheit below normal. Terrific anomalies. The idea that this cold outbreak is associated with climate change or a warming of the Arctic is really counterintuitive. First of all, if you listen to the headlines, they all indicate that this is the coldest since 1989. Then they say it's the coldest since 1951, 36, 2005, and then finally 1895. Well, if we're breaking records that are that old, how did they occur back in the 1800s and early 1900s? Because we didn't have global warming, and therefore we were able to get these record-breaking temperatures before global warming. I say it's something else. This graphic kind of shows what I'm focusing on is this big ridge that we've had that's created the drought in the western United States. But another thing is going on here. The equator is quite cold and the North Pacific is quite warm. And that means the normal sea surface temperature gradient has been disrupted because it's not as strong. The equator's not hot, it's not cold up there towards the Gulf of Alaska. And with a decreased temperature gradient then, winds die down, the jet stream tends to move north, and we build these big ridges in the East Pacific, which then brings down the cold air. So I went back to the last time in which the sea surface temperature was disrupted with a cold equator, warm Northeast Pacific, and composited then winter temperatures and rainfall. And if you look there for these 20 years, a cold northern plains is forecast every time we have La Nina and a warm Northeast Pacific. It just simply means the jet has been forced north, ridges form on the west coast, and the ridges bring down the cold. Likewise, I went for the annual precipitation during these top 20 years with the cold equator, warm Northeast Pacific. And again, we see drought was common all the way from California, southwestern US into the plains during these years. So I think the phenomena that's going on now has nothing to do with global warming. It has to do with that sea surface temperature pattern. This kind of puts it in another perspective. The upper map are those 20 years for temperature on the left and precipitation on the right. There's the mean temperature, 30-day temperature ending February the 17th. You can see the map is very similar to what the 20 years of those sea surface temperatures would suggest. Likewise, in terms of North America Drought Monitor, those years predict exactly where the drought is right now. So, I thank everyone for tuning in. I know it's kind of strange having a pre-convention talk like this, but it's great to be with you. And I really hope that you guys have a successful year and stay clear of COVID. Thanks for having me here. Thank you.
Bye. Welcome, and thank you for being with us today at the Winter Reboot. My name is Mike Murphy, and I'll be leading you through the grain and energy outlook for 2021. I want to say a special thanks to our sponsors, Zoetis and Purina, for all the support that they have provided to CattleFax over the years. As we think about where we are relative to the grain situation, there's several sorts of things that we need to think about in terms of the marketplace. And really to start, we need to go back towards where we were, or backwards, I should say, to where we were about a year ago. And with that in mind, it starts with that prospective plantings report. This started there in late March of 2020. That was a spot where the USDA had projected there'd be 97 million acres of corn planted from the US farmer. What transpired is we came through all the way to where we are currently. As you can see, we have this decline in acreage, and we dropped down to basically a little underneath 92 million acres. So that had a huge impact in terms of that change of that overall supply of what we expected to have starting last spring to where we ended up where we are currently. The same thing, not to the same drastic measure, but the same thing really happened on the soybean side as well. And that'll be very important as we go through our conversation about where we are with the corn market. Soybeans are a very important part of the impact that they're having on the value of corn prices today. Now, the other thing that we want to be able to understand as we go through that same time frame was the reduction in yield. We had, as Dr. Douglas kind of pointed out to us as we look back over our shoulder, we had some drier conditions there throughout the summer of 2020. And ultimately what ended up happening is we had about a 6 bushel decline in yield from those initial projections in May of 2020 to the final number that we got here just back in the month of January. So when you start to change that underlying supply by acreage and by the yield reduction, it certainly starts to set the tone that the market is going to have to fend off the buyers with potentially higher prices. Now, it's not strictly about supply. I think that's important for each of us to understand. There were certainly some impacts on demand. Now, the demand factor has been a little bit of a variable, right? It's been a little bit up and down as you think about the 2020 to 2021 demand sector. And we'll get into the details of each of the 3 key segments here in a few minutes. But the one that really stands out for us and has had the biggest impact has been on the export front. That initial expectation, when we think about the demand forecast back in May of 2020, to what we ended up at one point in time this past fall, the USDA had actually increased demand from the export sector by 600 million bushels of corn. And certainly that starts to play a role on the ending stocks. And that's really where we are today. As you go through this graphic here, you can see the changes for both corn and soybeans. Each of these periods, when we go from last spring to where we are currently, there's been revisions downward to that ending stocks number and ultimately downwards to that stocks to use, which is just that relationship of how much total supply is there relative to how much demand there is for the specific commodity, whether that happens to be corn and or soybeans. So now that we've kind of set that foundation of where we are from the last almost 12 months, and it's interesting to think back, both corn and the soybean market has been in a scenario over the last several years that we've been very comfortable with our stocks to use situation. And you can see that on the chart that you're looking at currently. Obviously, that's changed dramatically. You know, we've gone from where we were just projected back in the spring of 2020 on top of 22% stocks to use to now we are at about 10.5% stocks to use when you look at what the USDA is suggesting today. Now, you compound that with what was going on last spring, just in commodities in general. Think about that period of time of where we actually took crude oil futures negative for a period of time there on that one day as we went into expiration on the contract. We were in that spot where COVID was just weighing heavily on all sectors of our economy. And corn was certainly not, being impacted by that, as you can see the chart. We spent about 3 months last spring where the average spot corn futures prices were actually averaging below $3.30 a bushel. But that was also at the same time where we had this expectation and a forecast coming from the USDA that we had a more than adequate supply of corn, as you can see that from a historical perspective. So things changed, right? As that stocks to use decline, what had to happen? Price had to go up to be able to be in a scenario where we could ration against the tighter supply. Again, that tighter supply was driven by the acreage change and the yield change. At the same time, because of the demand increase specifically on the export front, we need to get prices high enough where we could start to try to find a balance there. And at this point in time, it appears that we're in a spot where between both the supply sector and the demand sector, we do have some balance on the corn front. Now, we all understand that we're going to quickly transition where our focus is going to move into new crop. The 2021 production, 2021 to 2022 sort of market year, crop year, and we'll start to get in some detail of what that could look like here in a few minutes. Let's look at the three key segments in terms of usage for corn. You've got feed and residual. We look at this number here, there's a small revision compared to last year. Most of that is going to come from the side of the pork industry and the poultry industry. Both of those, especially the pork industry, as we came through COVID last spring and summer, just didn't really have the benefit of kind of restocking their business, if you will. They're in a situation where they're slowing hogs down. And as that goes through that whole vertically cooperated system, back at the farrowing units, they just didn't have a chance to really restock. Margins were pretty thin at that time frame, especially there in the spring. And so as we kind of look into the current market year, you're going to see less corn utilized in the hog sector. Poultry industry, they can change quickly, but what we've seen so far, because of their margin situation, they haven't seen much of an expansion. Now, on the cattle side, we continue to have record cattle on feed numbers. The report came out this last Friday. The February 1 number is a record number. So you will see a lot of usage of corn at the cattle sector as we finish out this current market year. The key term in here, and we say this a lot, is the residual. And in a lot of ways, that's the USDA's error, if you will. What I think it's important to understand is that the corn basis, especially in that Western Corn Belt, which is where the drier conditions exist this past year, is probably telling you that in that region of the country, the residual is actually a little bit tighter. So this is a type of number that we've got to understand that the error, if you will, of the USDA is kind of built into this component of that residual number. Now, ethanol. This is a difficult one because as we start to make that year-to-year comparison, we're just now moving into the period of time as we think about in about 3 weeks when the country shut down because of COVID-19 this past year. And it stayed that way for several weeks and months into the late spring, early summer. So that was a period of time where there was nobody that was driving to speak of. And as we know, ethanol is a blended product into gasoline. So miles driven by the consumer has a direct impact on how much ethanol is going to be utilized. And so ultimately how much ethanol needs to be produced. The USDA does have an increase in this number forecasted for the current market year, but this could be one of those numbers that could easily be revised a little bit higher as we go through the spring into the summer. If the economy actually can get opened up quicker, and we start to kind of see a normal lifestyle come back to us. And I think those are the types of things that Randy had highlighted a little bit earlier. So if I had to pick one right now, I'd say this is one that we could start to see a little bit of a revision higher, which would then make our stocks to use a little bit tighter for this current market year. The big one has been on the export front, and it's really come down to China and in terms of their impact that they're having. And that goes all the way back to about a little over a year ago, the phase 1 trade agreement that President Trump had put into play with the Chinese. Certainly that had a huge impact on the overall demand for all commodities, but specifically on the corn side and to a certain degree, even on the soybean sector. So we look at this particular number. This is a number that we very much agree with in terms of the USDA forecast at about 2.6 billion bushels. And the reason being is because when you look at the Chinese numbers, now this, keep in mind, this is not what's been shipped necessarily from the Chinese or shipped to the Chinese at this point. This is some of their commitments, but you can see what that number looks like. It's a 700 million bushel. It's a huge, huge expectation of what the Chinese are going to accept from the US in terms of corn. And we believe that this will come true as we go through the current marketing year that'll end up finishing up on August 31. We don't think that the Chinese are going to back down. They continue to rebuild their pork industry. As they rebuild their pork industry, they have found to become a more efficient industry. they need to be utilizing a higher quality feed. So much of the old school kind of farming sector and Chinese would use scraps and just waste food that they would go ahead and feed through their hogs. Well, as they become more corporate through this transition, as they try to become a more efficient industry, and certainly as they do that rebuilding through the last few years because of ASF, they're going to be focused in on a more higher quality feed that goes into those animals. So they're going to need the corn. And right today, we're certainly going to be the ones that are going to be able to provide that to them because we do have that supply. And as you're going through a major rebuilding like the Chinese are, price is not going to matter as much because those hog producers today are making over $300 a head at this point in time. So feed costs are not a concern. So we very much believe this is a number that's going to sustain itself as we go forward here. Now, this is what he's referring to, that big decline in stocks to use as you start to kind of think about things from a soybean side, right? It's not just about corn. Soybeans have a major influence on us as well, because now we start to have to balance, and we'll get into that with our forecast of who's going to plant soybeans over corn or vice versa. They're going to compete with each other as we go forward. This becomes very important. Now, this has taken a little bit longer when you look at the 2-year period here of this big decline in stocks to use. But just to give you this perspective, right, on an annual basis, when we start talking about less than a 2.5% stocks to use, this is a big number in terms of the impact that it has on the marketplace. Very, very, very tight supplies. Today, the USDA is actually projecting 120 million bushel carryover. Now, keep in mind, in the month of December, our exports were way bigger than that number just in the month of December. So this is a frightening tight supply that we're dealing with on the soybean front. And like a lot of things, it's not just going to be able to find a resolution necessarily in an overnight scenario. It's going to have to take some time of building supply back up. Because again, as we think about on the demand front, we don't see that changing. Phase 1 trade agreement, looking at the soybean sector, you can see how the Chinese have been able to sustain some big buying from the US on the soybean front, and that's even with higher prices. Now, we're going to transition as we go through the spring where the South American crop will certainly start to come into their harvest period. And that'll give not only the Chinese, but the rest of the world another sort of supplier to be able to buy soybeans from. And that'll take a little bit of a pressure off of the domestic market. But this still remains a big challenge for us, is that demand growth. And that goes back to some of those things that Randy referred to at the very beginning, right? More of this bigger picture commodity sector. And it starts with supply tightening, but that the demand is there, which clearly it's there from the Chinese. That's what starts to drive this more impressive type of a move upward in the marketplace. Now, the one thing that is still a little bit of an unknown as you think about stocks to use levels, not only from a domestic perspective that we referred to earlier in the US, but also globally. There's a lot of private sector sort of analysts out there in the South American region that are actually suggesting that their crops, both in Brazil and to a lesser degree in Argentina from a soybean production standpoint, are going to be smaller. And with that smaller number, there's concern that our stocks to use numbers could actually decline and get closer to, say, 20%, which would be extremely tight globally, which then puts more pressure on a production being very large here domestically in the US, or we're going to have to take prices high enough to be able to kind of ration the usage and kill off that demand as we look forward. So that's something we'll be watching very closely as we go through this period of time here in the course of the next 60 days going into that key harvest window throughout South America. So let's transition, right, and think about where we're going to be going into the second half of the year and really looking at it from a relationship and going back to that stocks to use levels, because that's really what drives price. Number one, it's going to start with acreage. And this is where we've got three of the primary commodities in terms of what their plantings are going to look like. Our focus today is really going to be in on both the corn and the soybean sector. And what we've got forecasted today is that when you combine those two commodities, we're going to be at about 181 million acres combined. That'll be the largest ever in terms of those two commodities in terms of planted acres. Now, I think all of us, as we look at this internally from an analytical standpoint, we certainly see that there's a strong possibility that that number could be a little bit larger. It could be 182, it could be 183 million acres. That's definitely a strong possibility. And in some regards, especially as we start thinking about the soybean side of the equation, it needs to be larger because we've got to be able to balance the demand with being able to build that supply back. So this is where we start. We've got these acres. We shift the gears towards yield. Dr. Douglas went through his forecast. You know, timing is always everything as we think about production in terms of, you know, grain production. I would tell you as we look at it, the trend line yield that we've got built in here today for corn at 178.5, that's just a starting point. We'll have to reevaluate and reanalyze as we go through the growing season there in the months of June and July and August. But if you had to hedge this one way or the other, coming off of Dr. Douglas's forecast, you'd probably hedge it to be a little bit lower. Same thing as when we look at the soybean sector. Same exact concept in here, right? So you look at this relationship, you got a yield out there that's sitting in there at about 50.5 bushel trend line. What's important though is that notice we've only had 1 year where trend line or where yield has been at 52 bushels. So that's a concern that we have to have. And we'll get to that concern as we start to look at some of these variables and we think about stocks to use. So we're going to start with the corn side. Use an acreage number. We've got a full range in there. The key assumption that we have today is that our demand for corn in the 21 to 22 crop year relative to the 20 to 21 crop year is the exact same. That's the key assumption that we're making. So our focus here today is just to look at yield and acres. You start talking about 92, 93 million acres, and you start to look at a yield in there at 174.6, you're a comfortable situation in terms of your stocks to use. 10 to 12% is a comfortable scenario in terms of that stocks to use level. So corn really doesn't have a huge threat unless Mother Nature really derails us this summer. And what I mean by a huge threat in terms of prices are certainly going to be elevated, but not having that concern that we've got to take prices to that next level of say $6.50 to $8 a bushel, as long as we can stay somewhere in that 10, 11, 12% stocks to use number. So that becomes very critical as we look at things. And you can see if we were to go back and look at this from a long-term perspective, when we started having those periods of time back there in that 2011 and 12 window, that's when we were talking about single-digit stocks to use, 6, 7, 8. And that's what had prices as you look at the spot corn futures price at that more elevated level. We shouldn't have to worry about that today unless the yield underperforms this summer. So like most years, but this one more so than what we've seen historically, this summer's weather is very, very critical to the impact it can have on the value of corn. Now we look at it relative to soybeans, okay? And this is where things become a lot more concerning. You know, this is not raising the caution flag, this is raising the warning flag. This is a huge concern for us. So you look out there and you start to kind of measure. Again, we put a range in there between 88 and 91 million acres. You're in that kind of 90 to 91 million acres level. With demand constant in the next crop marketing year versus this year, to be able to feel any relief relative to our stocks to use environment, we've got to have the best yield that we've ever witnessed, that 52 bushel yield. That's not something, again, if we're hedging our bets relative to what what history has told us and what Dr. Douglas has certainly shared with us from a weather perspective, that's not a number that I would dial into. So you start to talk about a 50 to 51 bushel yield with that type of an acreage number, very little improvement, if at all any, to stocks to use. Something has to give in this market. Something's got to give in this market. And what that means is either we're going to go out there and buy a lot more acres back, or we're going to have to take price high enough where the demand for the 21 to 22 year ends up being less than it is this current market year. But something's going to have to give, because we can't sit there and be dealing with this type of a stocks to use level as we look at the marketplace. So as we look at the value of soybeans, we think we're very much in a spot here as we look forward that we're going to spend a lot of time between $13.5 and $16.5 beans over the course of the remainder of this calendar year. That's a very strong spot that we should expect to find prices to trade in. Any sort of Mother Nature scares this spring can have a definite impact on us as we look at things, or and I say this spring and or summer. So we should be expecting those types of concerns. Now, this is what I would tell you as we sit there today and we've got, where the new crop soybean market's trading in here on top of $12, and you've got new crop corn on top of $4.5, excuse me. If we expect to see beans where new crop can move towards that $14 or $15 number, even with the more comfortable supply scenario in corn, corn's not going to lay here at $4.50 a bushel on new crop corn. It'll be a passenger in the vehicle that beans are driving higher, and corn will be coming along right along with it. So when we start to evaluate where we are over the next several months, beans will have a greater influence on the value of corn. Now, that's not to suggest that we're going to ignore the impact of what Mother Nature can mean to us, because that is going to be super critical all summer long. But these types of values in terms of that really tight stocks to use on soybeans, the only way we can change that is to be able to take prices high enough where we kill off demand. And quite honestly, if we're in some sort of a kind of an inflationary commodity cycle that Randy referred to earlier, that might have to be back towards these record high levels. That's a definite concern that we've got to be looking at. Now, let's shift gears here and kind of final up as we think about the grain outlook. Let's talk about hay values. And really, there's some regional differences, right? When we start to talk about kind of the Central Plains going west, that part of the country, super dry, hay prices are elevated. We start to look at snowpack is coming back, like here in the state of Colorado as an example, we're about 90% of average. We would have looked at that same sort of level on January 1, have been like 75%. But you're going to be dealing with, as Dr. Douglas talked about, those drier conditions, and that's going to have an impact regionally on hay prices, especially the Central Plains into the Rocky Mountains and going west. More so Missouri going into the, say, southeast, that part of the country where there's a lot of cows, but a lot of forage. Feel more comfortable about those hay prices being, certainly higher on average because of the influence from other grain prices, but not so much they're going to have a huge impact on your bottom line from a cow-calf operation. So the final things that we want to talk about is a little bit of the energy outlook. And as we think about the energy outlook, well, I guess the slides didn't get into the energy outlook here. I apologize there. So with the energy outlook that we had, the bottom line with that is that we believe that the energy prices, the crude oil prices, are going to be moving back towards the high end of the range where they've been the last 5 years, which is about $75 a barrel. They may not fully achieve that here in 2021, but they certainly will achieve that as we look into the year 2022. So with that, I'm going to turn it over to Kevin Good and have him take you through the market outlook. Thank you for your time.
Thanks, Mike. It's good to be with you today as we work through the next 30 or 40 minutes. We're going to spend time mainly talking about 2021 from an outlook standpoint. With that said, as we look at it from a bigger picture standpoint, we need to recognize where we're at from a cycle. And when I say that, we need to figure out where we've got our numbers from a long-term perspective, both from a supply and a demand. It's got a little bit of technology problems here. We'll get that figured out. Hold with us for a minute. Be good shape.
Am I frozen? I can't do anything. You can't advance. It's just doing it.
Slight delay. As we think about it from a big picture standpoint, we're going to spend most of our time here for the next 30 minutes talking about the 2021 outlook. But I think we need to do a little bit of backdrop as we think about where we're at, in particular from a cattle cycle standpoint. In 2019 and 2020, we liquidated roughly 1.2 million head out of our cattle inventory. That's after we had a 5-year expansion phase of over 6 million head. As you can see from a long-term perspective, we typically will have a 10-year cattle cycle in the United States, and that goes back to the 1930s. But you can also see a differentiation as you start the 1970s, where beef production continued to climb higher over time. At the same time, cattle numbers from a cycle standpoint have been trending lower. Despite that, you can see gains in productivity within our business have made up the difference of those tighter supplies. So today, even though we've got a total herd that's 30 plus million head smaller than the peak, beef production is going to be record large again this year. And you can see some of the reasons that we've seen those gains in productivity. Weights are top of the list. Weights increase about 5 pounds per year on a carcass basis. We also tend to weigh more calves per cow exposed over time. And we really need to recognize that the importance of the dairy industry as far as more beef production from the dairy breed has become more prominent over time. With that said, we need to recognize a big driver over the last 2 decades, as well as where we think we're going to be going forward, is going to be more focused on demand. You can see between 1980 and 1998, beef demand was cut in half. During that same time frame, our total herd was cut dramatically as well. Since then, you can see that the rate of inflation has been a little over 2%, but you can also see that prices for fed cattle, retail beef, wholesale beef have gone up much faster than the rate of inflation. What that tells us, the dollars in the system, as far as where we're looking at from a demand standpoint. We all recognize the last 5 years, fed cattle values and live cattle values of all classes have not participated in the higher trend as far as retail values. Over time, that will correct itself as leverage comes back into our business. But as a backdrop, just recognize where we're at. Dr. Art did an excellent job earlier talking about where we're at from a weather pattern standpoint. And so as we back up and say, what's going to drive cow herd expansion or liquidation over the next couple of years, Mother Nature's at the top of that list. And unfortunately, with the forecast that was presented here this morning, you have to assume that Mother Nature is going to be working against us as we think about drought, particularly the western half of the U.S., over the next 6 months plus. And so that's a major headwind as we think about where we're at. Also, Mike talked about some of those inflationary costs as feed and roughage. That's working against us as well. The bottom line is, as we look at the 2 categories that drive the ship, so to speak, it's cow slaughter and heifer retention. You can see on the cow slaughter standpoint that it's been elevated the last couple of years. We're going to assume that this year it's going to remain elevated. So far, year to date, beef cow slaughter is up 5, dairy cow slaughter is up 4. It's a good forecast over time from a cycle standpoint. Supplies will get tighter as we go over the next 3 to 5 years. But this year in particular, with Mother Nature doing what it's doing on the beef cow side, and also on the dairy, we'll talk about the elevated feed cost. We can see that we're going to continue to see some mild liquidation as we go through 2021. Our forecast is this. We do think that we will continue to liquidate the beef cattle herd over the next 12 months. Primary driver is Mother Nature because of drought conditions continuing, and also increased input costs because of the inflationary cost, as we're talking about Randy earlier, as we think about total commodities, and also more specifically feed cost. With that said, when we finish up our time with you today, we are going to be pretty optimistic from a price outlook. So higher input cost, Mother Nature working against us. At the same time, we're going to get some relief. We would expect prices to be higher as we go forward. Another point I'd like to make here is that, hey, look at where the cycle low was from a beef cow number back in late 13 and early 14. We don't have to get that low. We don't have to liquidate near as many cows as we did the last cycle, primarily because we feel like we've got much better beef demand. The dollars are in the system. We just need more of those dollars to trickle down into the cow-calf producers' hands. Switching gears and talking about dairy for just a second, you can see that this last year, dairy cow numbers were up roughly 100,000 head, the biggest dairy cow herd in the U.S. since the mid-1990s. So you've had a very small, slight uptrend over the last 20 years. You can see the text box where we've seen some expansion, primarily in the high plains, as well as the Pacific Northwest. That's where we're seeing more of the mega dairies go into play. You can also see that we would have a slight decline in dairy cow numbers this year forecast. The drivers there, we would suggest, are higher input cost feed, as well as milk values that have came down compared to where they were through the second half of 2020. So that combination with what we're seeing for dairy cow slaughter year to date at 4%, would tell us that we probably see just a tick of liquidation here as we go through the year would be the call as we start 2021. With that said, let's start to build a supply forecast as we go through 2021. Fed slaughter should have peaked last year, but because of COVID, we couldn't harvest the cattle. So more of those cattle are on feed, as Mike alluded to. We've got record on feed numbers today. And so we'll have a pretty sizable kill this year. You can see that we would have just a tick shy of the 2019 numbers. And so when we start doing year over year comparisons here, we need to recognize that 2020 was so screwy with COVID that in a lot of cases, we're going to be better off comparing it to 2018 and 2019, those pre-COVID years, and in particular 2019, which in our mind was the peak from a cycle standpoint in steer and heifer slaughter. So we've got more cattle in the system. We think that we'll harvest more cattle, particularly in the first half of the year. And so the message to a big part as we talk about today is this could be very much a tale of two halves. You got big supplies on feed, big supplies on the front end, heavy weights, plenty of tonnage. That's a headwind for prices. And the market, even though we're going to talk it a little bit stronger going into the spring peak, is going to have some challenges. Nonetheless, as you transition to the two tighter calf crops that we had in 2019 and 2020, it should allow for tighter on feed numbers and tighter slaughter numbers through the second half of 2021, and in particular on into 22 and beyond, which Randy will talk about as he wraps up. So we've got a tale of two halves. From a cycle standpoint, we're transitioning. We still have ample supplies, and you can see that we've got plenty of bodies year over year, obviously, but also compare it back to the green line, which is 2019, because I think that really does show that, hey, still got big supplies from a cycle standpoint the first half of the year. We start to get some relief as we go through the second half of the year. That's going to be the message. Remember that when we start talking about the price pattern that we're expecting for not only this year, but as we move forward. On top of that, this year weights should drop back. Last year, they're record heavy. Obviously, we couldn't harvest the cattle. We had to feed them longer. This year, they're lighter, in our opinion, as the year progresses. Again, it's a tale of two halves. As you think about it, we still have some awful heavy weights year over year through the first quarter. We'll transition into lighter weights as we go through the second quarter. That was a time frame where a year ago we couldn't harvest the cattle, and we'll have most of that year over year decline as you finish up late third and fourth quarter as the feeding industry gains currentness and also leverage as we go through that time frame. So the message is long-term as cattle producers, we're all paid on pounds, so you can't bet against the long-term trend, but at the same time, you do have some relief year over year from a weight standpoint. You roll it all together for a production forecast, and you can see larger fed and non-fed slaughter, lighter weights to partially offset that. in the bottom line, it does result in about a 500 million pounds more product on the market this year compared to last year. 1.7% plus or minus. Keep that 500 million pounds in mind as we talk about what that means for the market going forward. We're going to roll in and talk about trade. Trade is going to be a tremendously important issue this year as we go forward. We're awful optimistic, and I think rightfully so, as far as what we're seeing in the data. Last year was a tale of the first quarter is very good. The second, third quarter were frankly disappointing because of COVID. We finished very strong in the fourth quarter of 2021 and 20. So far in 2021, the sales data and what we're seeing shipped would suggest those year-over-year gains are going to continue. From a currency standpoint, you can pick out the 3 Asian currencies that are all trading well above the US dollar. That tells us our product is more affordable on the global scene, and also compare our dollar versus the Aussie dollar. The Aussie dollar is stronger, they've got tighter supplies as they rebuild their herd, therefore they've got less product at higher prices. We're making inroads and gaining ground in both Korea and Japan compared to Australia, as well as gaining tremendous strides into China. And then also think what that means from an import standpoint as we go into primarily imports coming back to the US from Australia. What that tells us there is their product is expensive enough that we should expect less imports as this year progresses. So it's a tale here that's positive. One spot that I think we have to recognize we'll probably continue to get more product out of is South America. You can see their currencies are trading well below ours. So we will, in fact, probably continue to see more product in from South America. But definitely going into the Asian markets, we would suggest it's going to be pretty optimistic. So when you roll that all together, you think about what that means from a trade balance standpoint. We feel like that exports will be up 5%, primarily into the Asian economies. We think that imports will be down 5%, led by less product coming in from Australia. That's a 10% swing. And so let's remember, what's a 10% swing on a 3 billion pound market? That basically is 300 million pounds. I just mentioned that we thought production is going to be up 500 million. Balance of trade is going to eat up more than half of that, isn't it? So as we think about it, it's going to be very important, not only from a tonnage standpoint, but also an aggressive buyer in the beef complex, which we're already starting to see year to date. Some of the chuck items have been on fire, primarily because of that better export market. So if we roll that together, what's that mean to us? Really, as we break it down and think about the different markets that have been good over time, and you can see the trend into Japan, sharply higher over time. You can see South Korea continues to advance higher. And then we've got that star down there representing front door access to China. And it was 120 million pounds last year. But in November and December, both of those months, they averaged 25 million pounds a month. You do that over a 12-month period, that's a 300 million pound market as we think about going forward. And very well could be larger than that as we go over the next couple of years. So the message there is over time, we love the access we've gotten into China. We think that market will continue to grow for beef in particular. We also think that the other Asian markets, Japan and Korea in particular, were more price competitive compared to Australia. And we do feel like we'll continue to take some market share, especially over the next year or two. So we're optimistic there that we'll have some bright news from an export front. Let's roll it together and talk about what it means from a per capita supply standpoint. And therefore, as we start talking about demand here in a few minutes, what's that mean for price? Here you can see that even though we're producing more product, you've got a combination of better export balance as well as population growth. Basically, you've got flat beef supplies. And so the supply side, looking strictly at beef, really is still pretty constructive from a long-term perspective. Let's roll in pork and poultry. And in this illustration, we're just looking at the year-over-year increases as far as production from our estimate standpoint. Beef, we've already talked about. Pork, we've got pork production this year down compared to last year. What's the drivers there? Think about a year ago. The pork producer was losing money, so sow slaughter was up 13% in 2020, as well as farrowing intentions were down. So there's less pigs in the system. They've also got some herd health issues that are hurting them today as well. And so we would suggest that pork production will be lower this year compared to last. And frankly, that's bucking a long-term trend. Poultry production, you can see we've got it flat, actually up just a tick. What's the driver there? The driver there is increased feed cost. It's both corn and soybean meal. That takes away from profitability. And so you can see net, we've got production basically flat. Contrast that to the last 5-year average where we had production up basically 2.5 billion pounds per year on average the last 5 years. So it is a trend change compared to what we've been used to. So you think about that limited production growth. Exports continue to grow on all three fronts, and you can see how important it's becoming. 17 to 18% of all protein that we produce is exported. So it is becoming more and more important over time. And so as you do the math there, you can see that, hey, we're going to produce pretty flat numbers. We're going to export more numbers. We've got a population that continues to grow. What's that mean from a per capita standpoint when we roll in beef, pork, and poultry? And you can see that it is a trend change compared to the last 2 years. It would suggest about a 3-pound per capita decline. Of that, roughly about 2 pounds of that per capita decline would be on pork, and about 1 pound would be on poultry. And again, beef would be relatively flat. And so that is price supportive as you think about all the proteins as we go forward in here, that we've got a supply situation that really is different from a trend standpoint than we've had, as you can see in this graph and illustrate, since 2014, 2015. Since the last cycle high, supplies have gradually gotten larger each and every year on a per capita basis. Now you've got something different as you think about 2021. It's a decline across the board from a per capita supply standpoint, which should be, all other things being equal, price supportive as we move forward through the year. With that said, let's change gears and talk about demand. We talk about beef demand, to me, it's a good story, especially over the last 20 years. We've had more dollars roll back into our business. Here's an illustration as we think about per capita expenditures. You can see they've increased at twice the rate of inflation over time since the low water mark of beef demand back in the late 90s. And so the message here would be that we do have more dollars in the system. You might ask, why do you have it down 2% this year compared to last? Basically, it's just because the bar was set so high last year with COVID. Remember last year, if you think about retail prices, we averaged $6.38 a pound, all fresh, record high. We're suggesting that number could be $6.20 this year, which is still the second highest on record, but just off the peak from a year ago. The long-term trend, if you draw a trend line there, the 4% year-over-year increase, we're still on pace, in our opinion, to continue to see gains as we go forward in here. With that said, what is the big driver from a long-term perspective as far as better demand? Frankly, I think we just sit back and take a look at what we're producing. We've got a better product. We've got a better product than we had 5, 10, and 15 years ago. And we've got a better product compared to our competition. And the price spreads and the dollars the consumer is willing to spend will really drive that message home. The grade last year increased 3 ticks when you look at prime and choice together. Why? Obviously, we fed the cattle a lot longer because we couldn't harvest the cattle. So that's an upward bias to grade, as well as just the long-term march higher because of genetic improvement. You can see that we've got it down a notch this year, frankly, just because as we go through the year, we're going to get a lot more current on the front end. We'll have less days on feeding the cattle. But at the same time, we would still suggest, hey, genetically, the U.S. cattle herd will continue to grade more choice and prime as a percentage over time. That's what's driving demand. The dollars are flowing back into those right type of cattle. We see that trend continue. So as you think about that, over the last 20 years plus, you take the tonnage, you take retail price, and what's that say for not only the dollars coming back into our system, which beef has been higher over the last 20 years, what's that mean compared to our competition? And I think it really drives the point home as you think about market share at retail. You look back to 1980, 1998, we lost basically 15% of market share. Beef demand was cut in half. Total herd was cut dramatically. What's happened over the last 20 years, you can see we've gained market share. And I think it's very important to look at this past year in particular. With the pandemic, people are staying home, cooking at home. What was a protein of choice? It was beef. The dollar spent obviously showed that. So that's a good message from our industry as we think about the product we're producing. Where did we take that market share from? We took it back from both pork and poultry over that 20-year time frame. Just throw this in here just to stimulate the thought. As we think about here, Randy's already alluded to the fact a lot of dollars being pumped into the economy. It will be inflationary over time. This is just an illustration as we think about the stock market that continues to trade near its all-time highs. The consumer comfort dropped like a rock. It's came back. Vaccine rollout as the economy starts to regain footing and with commerce starts to happen more readily, we would suggest that, hey, we'll start to see retail that's been carrying the ball. We're going to have to see going forward food service to pick up some of that ball. But frankly, what we're seeing out there is retail. They've moved a lot of product, good features over the last 12 months. They're not going to give up market share to food service very easily. They're going to fight for that market share. At the same time, you've got exports coming in. So you've got a three-pronged demand factor that should be supportive to our protein as we go forward through this year. Exports, just as a reminder how important exports are. You can see it here on a dollar value, but if you roll that and talk about what it means as a percentage of the Fed steer value, it's roughly about 20% over the last 3 to 4 years. That basically is back on a percentage basis to those pre-COVID or those pre-BSE years. So we've got to recognize that, hey, trade issues are extremely important as we go forward, as they've been in the past. Let's talk about the forecast as we go forward in here through the remainder of this year in particular, and really the message that we would have from a long-term perspective as we think about it in here. Look at the trend from a beef price standpoint. And you can see that it's basically a 4+% over time. Yeah, you've got the blow off top in 14 and 15, going back to the recession, or excuse me, going back to the cycle high. You can go back to 2009, you can see the recession there. And we're just suggesting that you continue the upward slope, but off last year's highs. Now, as you think about what the beef complex has done year to date, and you look at this forecast, you might be encouraged that, hey, we might be able to do a little bit better than that. Only time will tell, but we're going to use 120 or 225 as our base as we work through the annual forecast. And we can talk about which way we'd want to tweak that if you've got a different preference from the demand standpoint. The real message as we think about price discovery, short to intermediate term, really centers around leverage. We talked about that as we think about from a long-term perspective, there's plenty of dollars in the system. How those dollars are divvied up is really the challenge for the cattle feeder and therefore for the cattle producer. You can see that last year the cattle feeder received its lowest percentage on record. Obviously, when we shut packing plants down in April and May of last year, cattle got backed up, no leverage to speak of. You can see that we feel like leverage will improve as we go through this year, kind of back to those pre-COVID levels. Take that with a grain of salt though. Short term, we still got record on feed numbers, so we've got a challenge short term. Longer term, as we go through the second half of this year and beyond, getting into those tighter secular numbers, it's going to be easier to squeeze, or easier at least to get a bigger piece of the pie. And you can see what that means. So we started out with the 225. We're going to suggest a 49% percentage from a leverage standpoint for the year. You tie those two together, add in a drop credit of $9.50, it ends up with about $1.19 Fed price for the year. So we'll use that for our base as we think about this year. Hey, if leverage isn't quite as good, prices probably average a tick lower. But that very well could be offset by a higher beef complex when it's all said and done, just because of the trend we're seeing year to date. So we'll use that as our base. Using that as our base, let's recognize we're in a non-expansion season. In other words, as we look at it today, we're going into tighter supplies over time, not only through this year, first half versus second half, but also over the next 3 to 5 years. So with that said, we started this year at $1.10. If that's the case, we would suggest potential at $1.20 or a little bit better for a spring high. But then you've also got to recognize you've got risk back this summer closer to that $1.10 level, plus or minus. The absolute highs should occur the latter part of the year in the fourth quarter, as illustrated here, not only this year, but as a general trend from a cycle standpoint over the next 3 to 4 years. So you need to think about this as you think about where we're going, not only just look at the total price, but also the seasonality is going to shift from what we saw as we're working into bigger supplies. In bigger supplies, front end's got the high, the fourth quarter's not as high. Now you flip that because of where you're at in the cycle. So let's remember that's where we're at looking at the Fed market. With that said, let's roll in and talk about the yearlings and calves here real quickly. And on the yearling side, you can see that we've got prices upward bias this year, back to maybe a tick above those pre-COVID levels. You know, you've got a headwind of high grain values. You've got a headwind also of lack of profitability short-term as far as feed yards, cash to cash. So those are some challenges. But as you roll forward through the year, you get into the tighter calf crop from 2020 and your supplies becomes more supportive. And also as you roll forward through the year, think about that previous slide with our highs end of the year from a cycle standpoint, that tends to be supportive for the year in the market as well. So when we talk about an annual average at 145, frankly, we're at 135 or less today for the lows. That's where our lows are for the year. Seasonally, you should move stronger as you move from the first quarter on into August, September, where's your typical high. In non-expansion years, like we would suggest this year is, your late summer high, you prolong that, and the fourth quarter, you don't have a drop back like you typically would have. That said, let's talk about the calf market. If you think about the calf market, similar pattern. We would expect us to bounce back here initially to the pre-COVID levels as we talk about 2021. And the message here is that, hey, you can see the range. We're basically in the mid 160s today. We would suggest you go into green grass fever going into the spring. You get up to 180 plus or minus. And then also you have a very similar price pattern change from a cycle because of where we're at in the cycle as you go through the second half of the year. Yes, your lows still occur in the fall run. You still have a drop there, but it's much less pronounced than it is in the long-term average. And then you typically have a pretty nice rally into the end of the year. So what that would suggest is during the fall run of this year, we could easily average 10 to 15 cents higher than we did a year ago. Very well could sell a lot of cattle between $1.60 and $1.70, even $1.75, depending on where we see back end of the Fed board, which is carrying a premium. We need to recognize that. We support the both the yearling and the calf market going forward, and also what happens from a big picture standpoint as you think about the grain values and some of the things that Mike and also other that Art's already talked about. So to wrap it up, put a bow around it, this is just looking at it from an annual average standpoint. Again, I think we need to recognize that we still got big supplies through the first half of the year, transitioning into tighter secular supplies, not only through the second half of this year and beyond. So I think that's a theme we've got to carry. Demand is very stout for beef, and also, frankly, the other proteins are trading well above year-ago levels year to date. Leverage continues to be the issue. We see that transitioning from a first half challenge to something better as we work through the second half. Laying that together with the grain outlook, weather outlook, you can see that we would have all classes trading higher than a year ago. Just a note on utility cows, even though we've had huge slaughter the last couple of years, utility cow slaughters actually saw their low water mark in 2018. They've trended higher for 2 years. Strong trimmings or hamburger demand has been a real big driver when you think about that particular item. And what are we thinking from a cow slaughter standpoint over the next 3 or 4 years? Tighter supplies, keep your demand in check. Tells you that utility cow value is going to be a bigger piece of our paycheck for a cow-calf producer as we go forward. So with that said, I'm going to wrap it up and say thank you. It's good to be with you today. And I'm going to turn it over to Randy Block to take us home with a longer-term outlook as well as factors to watch. Thank you.
shower. Switch your quick test.
Kevin, great job. Both Kevin and Mike did a wonderful job of bringing you all up to speed and catching you up on what we see as far as the overall market landscape that we're going to be dealing with here through most of 2021. I think as you sit back and you, as Kevin suggested, let's look at it a little bit longer term. I want to just remind you all that when you look at the chart that you have in front of you, keep in mind the U.S. is the largest beef producer on the planet. And again, with our high quality fed beef production that we have in this country, we produce about 75%, probably 75+% of all the high quality fed beef in the world. So again, our product is a bit different than what we see from some of the other competitors out there when we think about why are we seeing demand so strong. A lot of that ends up going back to that high quality choice certified Angus beef, upper 2/3 choice and prime market that we deal with here in the United States. So keep this in mind when you're looking at the overall landscape of where our position is. We think we'll continue to be the largest beef producer as we look down the road here over the course of the next several years. Now, Kevin went through the 2021 outlook, and I think did a great job of giving you details, talking about leverage and the shift that we go through there. The bottom line is, over the course of the next 3 to 4 years, fed slaughter is going to decline. We're going to have declining fed slaughter. We're going to see things tighten up along with that smaller calf crop, smaller cow herd that we have out there. And as a result, look how the slaughter capacity utilization piece shifts. We've been in a situation here over the last few years, 2020, and let's just isolate it. We had 12% more cattle than what we had hooks available on a 40-hour, 5-day week. That's why we didn't have any leverage. This year, the leverage position will improve. It'll get better and better as the year goes on, especially into the second half of the year. Look at the transition that we'll see as we move through the course of the next 2 to 3 years. So again, and we've got some additional packing plants that'll be coming online. Again, a 500 head plant here, 1,000 head plant there. All of that added capacity will be good for our industry and will help level the playing field from a leverage standpoint over the course of the next 1 to 2 years. So I think this is a positive situation that it is developing. I know everybody's been frustrated that we haven't been able to get leverage back for the last 18 to 24 months. Still not there yet today, but I think we'll see that transition improve as we move forward. Kevin showed you what the leverage position looked like, what we're getting from a fed cattle standpoint relative to the wholesale beef market. This is looking at it from a retail standpoint. Keep in mind, in 2020, retail beef demand was record strong, strongest it's been in 30 plus years. And yet we weren't able to capture that, were we, as cattle producers, whether we're a cow-calf producer or a fed cattle producer. We couldn't capture it because we had a bottleneck there, not enough harvest capacity in our industry to work through that backlog supply. We'll see some of that improvement back in here this year. Just keep in mind, there is still a lot of margin above us. We don't have to grow demand substantially in here from where it is today to see fed cattle prices, cow-calf prices, feeder cattle prices get higher. The margin's already there. We're just talking about a redistribution of where some of those margins are. And again, that's what will lead to prices improving more quickly as we move into the second half of this year. And it'll be even more noticeable as we get into 2022 and 2023. So bottom line is, again, we've been through a tough situation in here over the course of the last couple of years. I started out my presentation this morning talking about the Tyson fire in August of 19. Then we'd had COVID here in 2020. Again, keep our fingers crossed. We have no more of these black swan events that we have to navigate in here. But the bottom line is we see things on the mend. And again, a 1% shift in this is worth $6 a hundred. So again, there's a lot of margin above us that we'll gradually recapture over time. The other thing I want to just come back, Kevin talked about how much more choice and prime we have from a percentage standpoint. I wanted to just give that to you from a perspective of a tonnage standpoint. The U.S. consumer has said to us, we want more of the good stuff. We've seen over a 60% increase in the amount of choice, upper 2/3 choice, and prime beef production in the United States in here since back in here in the 2000 to 2005 time period. Unprecedented what that signal has been. And even though we've seen that kind of increase in production levels, look what our spreads have done. If you look at the black line on this chart, that's the CAB to select spread that you see there. Look how that spread has continued to increase, has continued to get higher in spite of that huge increase in production we've seen out there. That is classic beef demand growth. That's the consumers voting with their pocketbooks saying, we want more of the high quality stuff. And again, when the restaurants were closed down, they didn't have the opportunity to go out. So we saw more of that demand shift back. That signal was at the retail counter. And again, we're seeing more of the high quality product that has been merchandised at retail counters than any time in the past. I don't think that will go away once these restaurants reopen more wide open on into the spring and summer of this year. The purple line that you see on this chart is the prime to select spread. Again, you saw that spread narrow some as we came through this year. Again, it narrowed in here. That was really more of a result that those restaurants weren't open. But most of these other spreads, again, they have been strong. Choice select spread's been strong. CAB to select spread's been strong. Again, this has been a very, very clear signal that the U.S. consumer is transferred back to the producers of the livestock in our industry today. Kevin mentioned where we are from a spending standpoint. Again, this is, I don't want to spend a lot of time regurgitating this, but I think it's important for you all to really understand what this is saying. 8% more of the total dollars spent on beef, pork, and poultry, 8% more of that is going to beef. Again, we have differentiated as an industry because of the quality product that we're producing out here. We need to make sure that we continue to listen to that consumer. That's been an incredible lesson in here over the last 40 years to see this thing shift from the low water mark we had in 1998 to where we are today. Now, there's been a lot of discussion in here over the last few years about these alternatives. Are they really making some inroads? Yeah, they've made some inroads in here, but we're still talking about a very small percentage of the total. Less than 0.4% inroads in here across all animal proteins. Less than 1% market share against beef by itself. So we think they will continue to gain some market share going forward. Keep in mind, we've got a population that is growing around the globe, 80 to 83 million people a year. Just to feed that increasing population, I think is going to require that we have more of these things that are available to help do that down the road. So again, I don't think we should be threatened by this at all. I think if we continue to stay focused on what we can do best and tell our story, I think we've got a great future ahead for animal proteins as we look down the road the next 10, 20, 30 years. From a long-term pricing standpoint, I want to be very clear. The cattle cycle lows were in 2020. That was the cattle cycle lows. Prices are going to get higher over the next 3 to 4 years. These could be accelerated in here as a result of the overall economy, the amount of money that consumers have, the way the global economy will come back online, the way we expect to see inflation pick up in time. These trends are, I'm very confident in the trends that we're showing you here, that we're going to see all classes of cattle get higher. But it's not all about cattle, is it? We're going to see grain stay higher, as Mike said. Oilseeds probably going to stay more elevated. Obviously, the other proteins are sharing in some of this same rise. So this should be pretty well across the whole meat platform that we see going forward. But again, a much, much more positive situation for prices in total. Profitability, though, is why we do it, isn't it? If you go back, I want to remind everybody on the meeting with us today, if you go back to 1980 to 1998, the industry in total only made $32 a head in that 20-year time period. $32 a head for 4 industry segments to split up. That's not enough to buy lunch, is it? Look where that's been in here over the last 20 years. $260 a head profits. And if you look at the 6 of the last 8 years, we've been over $400 a head profitability for these 4 industry segments. I know a lot of you out there saying, yeah, but look how big that yellow bar is. Packers are making all the money. The Packers have made a lot of money in here the last 3 to 4 years. Again, I want to emphasize this is not a bad story. That demand is out there. As we get ourselves in a better situation, that is demand we don't have to grow or build in our industry. This will be margin redistribution that we'll see take place here over the course of the next 2 to 3 years. So again, I think there is a positive story in there as we look down the road and we see how these prices can move and move pretty quickly in here over the course of the next 24 months. I want to share with you a couple of the big picture things that I think are important for us in the industry. As we all know, as we look at the way our system works today with the differentiated product, the premiums that we have, you can read this, you can go through it. The areas that are highlighted in yellow, these are attributes that I think are going to continue to become more and more important, and they're going to add value to the product that we're producing. Animal care, history, food safety, sustainability, that record, the story. You can go on into all the detail. Each one of these things, I would just say to you, where do you as an individual producer come down on each of these? How many of these things can you quantify and qualify today? I would say to you, I think a number of these are going to have value in your production systems here over the course of the next 3 to 5 years. So don't go to sleep on that. Again, when you've seen all these other things that have changed in the last 20 years, these areas that are highlighted in yellow, I believe, are going to change as well. There's been a lot of discussion about price and value discovery in our industry. Obviously, price discovery is very important. The cash market's been thinner, and especially in some of the regions that we all know about. And I'll just say it again, if the cash market's worth saving, producers need to save it. I do not believe we want to invite the government in to fix this problem. That will not be a good solution for our industry. So we need to save it. We need to do what we need to do if that's important to us as an industry. I think you're seeing a lot of efforts go into this, and we're seeing some improvements here over the course of the last several months. I think we'll see those continue here going forward. This balance between price and value discovery, I think I've emphasized that to you. Kevin has showed it to you in a lot of detail. This value signal has been a major reason that we've experienced the beef demand growth that we've had in this industry especially over the last 15 years. So don't lose sight of that. We have to have a clear value signal. When we get it, we tend to respond to it very, very well. When I summarize things, obviously, I think we've gone through this, but let me just hit a few of these things as I finish my remarks here. Numbers are going to continue to contract. We're going to gain leverage back in here. We're going to gain some packing capacity, but again, we're going to see things come back in balance. We expect we're going to see significant investments in technology, more robotics, more cobotics come into these marketplaces, particularly in our processing plants, that are going to add some additional efficiency. We've talked about grains being higher. Obviously, the annual growth trend for meat and poultry, those things from a production standpoint, they're going to slow down a little bit in this high grain environment. It'll tend to slow down a little bit. So we don't expect to see as big a year-over-year increases in those production levels. And of course, the export numbers, as Kevin illustrated, those are going to continue to increase. Don't be surprised if exports aren't up closer to 10% this year. And we can see bigger exports looking down the road here over the next 2 to 3 years because of the product that we're producing in this country. Beef demand is on solid ground. I think we've shown you that. every which way we can. It looks excellent as long as we stay focused and we continue to do what we need to do to meet those consumer demands and needs. We've got prices moving higher. We've got profitability improving for all segments of the industry. The global population, I've mentioned that to you already. And again, consumers want to continue to be tied back to brands that they trust, don't they? Source, traceability, animal care, sustainability, all of those things are going to continue to be important. We've got a great story to tell as an industry. We need to make sure we tell it. I want to say thank you to all of you out there that have been such true supporters of CattleFax over this last 50 plus years. And again, for those of you we regret we can't shake your hand and sit down and visit, but we'll look forward to that opportunity being with you again in August. And for those of you that will join us all in Nashville, we'll look forward to the opportunity to being in front of you again at that time. Please help me thank our sponsors. Again, Zoetis, Purina, they've been long-term sponsors for CattleFax. They've been great partners for us over the years. Please support their businesses. Thank you very much. Hope you have a good spring and summer, and let's pray for some rain. Thank you very much.
Next on our agenda is some exclusive time in the virtual marketplace. This is your opportunity to interact with our fantastic exhibiting companies. You know, they paid to be here. And also you want to miss out on any other content. So be sure to take advantage of this time. You simply return to the home screen of the virtual event environment. There, you'll click the virtual marketplace button. Our exhibitors are standing by to visit with you. Now, when you're ready to return to the presented content, just go back to the home screen. Click on the full schedule button at the top of that page, then navigate to the appropriate session you'd like to join. We'll see you right back here real soon.
Are you concerned about the impact government policies could have on your cattle business? One way to make your voice heard in Washington is by joining Ncba. When you join, you'll have access to key policy updates and insights from Beltway Beef. It's the best way to hear directly from Ncba's DC team. Beltway Beef provides valuable policy information, and it's free for Ncba members. Stay in touch with Beltway Beef. Join now at ncba.org.
What's up, y'all? Julia Cole here. We want to invite cattlemen and women to attend CattleCon 21 in Nashville, August 10th to 12th. It's the largest event for the cattle industry and a whole lot of fun. We can't wait to have everyone back in person. Convention.ncba.org. Mark your calendars.
Visit the virtual marketplace for your chance to win today. Just visit any booth in the virtual marketplace and click the Scan My Badge button. The more you scan, the more chances you have to win. Are you on the hunt for a new custom hat? Well, then you're in the right place. Thanks to Greeley Hatworks, you have the opportunity to win $500 off a handcrafted hat. Visit the virtual marketplace and search for all of the hat images hidden throughout the trade show floor. Once you think you've found them all, swing by the Greeley Hatworks booth and let them know what you found, and you could be entered in the drawing for a $500 hat voucher.